When we talk to our investors, all of them are passive, right? They are looking for somebody that they trust first and foremost, and second, that has had the experience or is doing that. We have an investor relations person full time that gets to know our investors. I also have a personal relationship with all of our investors. We're in holiday mode right now, so we're doing holiday gifts and cards, and we're calling everybody. So it's getting to know them and understanding where they are. We maximize the value of the land through its best use, did all the hard work leasing up, and then when we sell it, a huge equity return comes our way.
You could get basically a private loan, right, from individuals to go through your entitlement process before you even open it up to limited partners. And people could technically invest and receive up to 15% annual interest. Most banks would give you 50% loan to value. Some private lenders could go up to maybe 65% loan to value. It's less common and it's a lot more expensive.
My goal is to make those investors out there as wealthy and as quickly as possible so that they tell their friends and they come back to us.
They sued them and won a huge settlement. I was shocked. I'm like, so many times I got angry at municipalities and I'm like, I'm going to sue them, but everybody's telling me, don't bother.
Yeah.
Going against the city isn't going to work.
No matter how successful you are in development, like show up, be that person, to talk through your plans, because there's certain things you can outsource, but when it comes to that, I just feel you have to show up.
Wayne, welcome. Another episode of Real Estate Development Land to Legacy. Real estate development. Wayne, why don't you introduce yourself and let us know who you are and what you do?
Absolutely. Thanks for having me on the show today. I'm super excited. It's fun because this one is going to be heavy on development. Obviously, we'll probably go into side conversations on other commercial real estate, but it's the first one that I've been on that has been really tiered towards development. My name is Wayne Courreges. I'm the managing principal of CREI Partners. We exist to help grow and diversify our investors into commercial real estate. And our focus has been multifamily, storage, some retail, and we've got one build-to-rent community that we're developing in outside Lafayette, Louisiana. Right now, we've got about 50 million assets under management. We are full-time doing this. Prior to CREI Partners, I was with CBRE for a total of 16 years. So my whole background and life has been in commercial real estate. So excited to, get the show rolling, however direction you want to take it.
I love talking about development and different paths that led people to real estate development. It sounds like you're acquiring existing assets and also developing new assets. Is that right?
That's right. We primarily buy existing assets, with some value add. We focus more on the Texas Triangle. However, I've been seeing such great investment development opportunities in Bryan-College Station, Texas, where I'm actually based out of. We've been working with the city on rezoning some land, and last year we built this 20 by 50 storage in Bryan. I'm happy to develop properties that are within an hour of where I live because I'm extremely involved. I want to go to the property often. It's not something I outsource, but when we buy properties outside of that area, I don't really want the stress of development on that. Now, as the company grows, we'll buy a property, say in Houston, which is about 2 hours, hour and a half, 2 hours away, depending on what parts of Houston. That's always going to be a property that's already established, and there's some value add component, not the heavy lift of a development.
So when you look at different properties, different opportunities, how do you evaluate the risks? I think most people understand that new development is riskier than existing. But then there are a lot of unknowns with existing properties too. How do you evaluate and how do you explain risks to your investors?
Yeah. So when we talk to our investors, all of them are passive, right? They are looking for somebody that they trust first and foremost, and second, that has had the experience or is doing that. And they don't want it to be the first deal that you're working on, right? But we all had to start there. But it gets easier for those active investors who have gone through a lot of the ups and downs of the markets and proven to get. So I would say the answer to that more so is, what is the appetite of the passive investor? The investor who already has a day job or wants to be in real estate but doesn't want to be dealing with real estate, right? A lot of them are high net worth individuals. They need the tax depreciation or the additional income, or they just want to diversify because they don't want to be too heavily invested in Wall Street. So within that, it's risk levels determining, are they cash flow investors? Are they equity investors? Two different types of investors. There are investors that are getting into the later years of their career. And so what they're really focusing on more is cash preservation and cash flow. And so we offer those through our multifamily properties, primarily value add, not these deep value add, but properties that already cash flow in day one. We're either doing a loan assumption. Most recently, we did a 3.82% fixed rate loan assumption. And it was, fantastic deal, cash flows, bought it right. Had another deal where it was seller financing, fixed rate, again, cash flows day one. And we distribute cash flow from the property without those past investors doing. Those are less risky because there's not a huge value add plan, even though there are value add and we expect to grow force appreciation through, income, reducing expenses where we can. But when I say it's not a deep value add, it's not something where it's like 70% occupied and we're having to go through a huge turnaround plan. I have one of those properties I did in 22, and I don't really want to do that anymore. It is a lot of stress. And not only can you renovate the property and make it exactly how you want it, but there's a lot of external forces that could also impact. So now we're buying value add properties, not major lifts, but that cash flow. So that's that cash flow investor. Then you have your equity upside investors. I would say a lot of our capital is in this bucket. Is we're mid-careers. We have 20, 30 years left on the horizon of working. What I want to see is over 5 to 7 years. And I want to see a faster return. I'm not as worried about cash flow, even though it's nice. That's where the development comes to play. Development is the riskiest asset class there is, but it's also the best way to grow wealth from an accelerated standpoint, because you have that, you take the biggest value add out there is raw land and developing it to its best use, and either cash flowing it for a duration of time. Those could be forever, some 5 years, or selling it, right? So hopefully that answered your question, but mostly the investors have to determine for themselves, are they cash flow, are they equity upside, maybe a mixture of both, because our cash flow does cash flow but also has an equity upside at the end. So I always put it back on the investor. What is their risk tolerance? And fortunately for us, we do both. And so we allow investors to choose what's best for them, and they can take each deal that we do to determine if it makes sense for them.
Okay, so the investor comes in and says, hey, I like the idea of real estate investing. And then your first question to them is, okay, well, what does that mean to you, right? What type of risk profile are you?
It's
Okay,
heavily educational, of because a lot of times they don't really know, are they cash flow or the equity upside, but it's really getting to know them. And we have an investor relations person full time that gets to know our investors. I also have a personal relationship with all of our investors. We're in holiday mode right now, so we're doing holiday gifts and cards, and we're calling everybody. So it's getting to know them and understanding where they are on their investment cycle, and what's their tolerance.
Okay, so in terms of returns from these investments, income producing building, apartment or self-storage building versus a new development, how do you compare them?
Yeah. So what we typically structure is, from a cash flow standpoint, we typically see 7 to 10% cash on cash. So there's different buckets within each investment with different return metrics. So if you're coming in with a higher check, you're going to have better return metrics than somebody who is investing the minimum investment. And there's no right or wrong in that. It's just to get the deal funded, we have to incentivize, right? So it does range from 7 to 10%. But that development, 7 to 10%, doesn't happen until the property is developed, obviously. And then once it leases up, what we do is a preferred return. So the moment they've signed the paperwork and invest in the deal, up until the point where we're starting to do the cash flow to the investors. All of those past due accruals, all the accruals have to be paid before us as a general partner benefit from those returns. In some cases, too, it has to take until the exit of the property. We sell the property and there's a catch up. But the thing that really is important here is those that are investing in development deals, though it's not cash flowing day one, it's accruing that interest as if it were. And then once it does start paying off, the investors get paid. All developments are going to be a little different. Every sponsor is going to be a little different. That's typically what we do. I've seen deals where it's like, hey, it's 60-40 or 70-30. I typically, for our investors, because they're putting in a heavy amount of capital altogether, that they should benefit from, the cash first, and then we benefit second. It also sets the carrot nicely where we're incentivized to perform and get the deal leased up and stabilized as quickly as possible. What we see on our returns, though, is typically 20 to 25% IRR. Now, that is cash flow, but also heavily at the exit, because you're taking, again, raw land and you're getting it to a point where we maximize the value of the land through its best use, did all the hard work leasing up, and then when we sell it, a huge equity return comes our way. From a stabilized multifamily or value add, typically what we'll see is going back to that 7 to 10%. Most of our investors are 7 or 8% pref. So every year they would see a 7 or 8%. The investors who want more of that cash flow, maybe they're not looking for the upside, we can go up as high as 10% pref. So their 10% gets paid first, followed by the other asset classes. And then what we typically see is a 15 to 20% IRR there. So we're underwriting deals. I have an analyst full time. If we're at 14 or 13%, we're passing. If we have to stretch to make the deal at 15%, we're passing. 15% IRR is for us the minimum. 20% IRR for a development is our minimum on the internal rate of return.
Gotcha. Yeah. So that's interesting. 15% IRR on existing income producing properties, 20 to 25% IRR that the limited partners get, right? It's not the project level return. It's
that's
what
right.
the investors get.
That's where the limited, that's a great point. Yes. So the limited partners get, because from a development side, it is a little more risky. Now, part of that risk is done upfront by us. And I say that because for example, we're developing a 150 unit development multifamily in Bryan, Texas. It was zoned. I had bought the property because I knew I was going to do retail or do something there anyway, but it was already zoned. So I reduced the risk because I knew hey, something's going to go here. Didn't know exactly what, but I went through an architectural process and city permitting to get it rezoned to multifamily. So now it's 150 unit planned development multifamily. But to get from the start to buy the land to get to that architectural is about $200,000. That $200,000 is risk capital that I've made into that type of deal. I can still lose that deal if we don't push forward, right? We still have land. I will say there is value in the land, so we're not completely out, but there's still that risk. Once that plan development gets approved, I then still have to go through construction drawings. I still have to go through civil engineering drawings. I still have to pay the geotech engineer. And the list goes on, MEP and all. That's another $200,000, $300,000. So there's a lot of risk that the developer gets on bigger projects before they even go to the equity side. So by the time it gets to the equity piece, a lot of the risk has been reduced. Now that's for us. There may be other developers out there who go out to equity first thing during their entitlement process. I don't want to have that risk on our equity investors. Now I do have investors, they like the debt piece. So they are okay with doing securitized by our net worth and other properties. So they'll come in and say, okay, well, I'll do 200,000, but I want a 15% annual return. And it's going to be collateralized by the land and, Wayne's net worth and liquidity. So, there is different types of investors out there that are listening. There's debt side and then there's equity side. And so depending on, again, risk tolerance, which I think from a debt side, if it's securitized, it's a great reduction of risk and a great return interest. It's something for people to consider and talk about.
Well, so that's an interesting point. So you could get basically a private loan, right, from individuals to go through your entitlement process before you even open it up to limited partners.
Mhm.
And people could technically invest and receive 15%
Yeah, that's
annual
for
interest.
us. Yep. Do the first 12
Yeah, that,
months 15 and then months 13 to 18 or 24 at 18%. So we penalize ourselves if it goes past the 12 months,
mhm,
but then it's securitized by the land. And then, we don't do a lot of these projects where it's like we over leverage ourselves from the debt side, but
mhm.
like there's value in the land itself. And, for us, we typically buy off market. So because Bryan-College Station, we live here, we have a lot of the relationships with landowners. And also we start having those conversations. We buy it off market. And not all the cases. We bought land, we bought recently land that was on market, but we also did it strategically through too. So like you look at your total cost of capital, right? So your total cost of capital, if I do a seller financing deal, which every land that we've purchased, knock on wood, fortunately, has been seller financing. I haven't had to go to the bank on it, but we've been able to do a seller financing. So say it's $1 million piece of land and the down payment was 100,000. Well, that $900,000, that's the seller financing note. That $900,000 is at a 6% fixed rate for a period of time. So if I look at a 6% and then I'm bringing in a partner or another lender, second lien lender, typically our investors, they're people that trust us, that know us. If you've got a deal and you're just calling someone up, they don't know anything about you. But having those relationships matter early. But say they're at 15%. So if you take the 15 and the 6% and you combine it, you're about what you would be paying if I had gone to a traditional lender for raw land. So that's where, with the cost of capital, I feel comfortable that once we blend the two pieces, we can, get the land and get a lot of the soft costs proceeding before we take it out to equity
Yeah,
investors.
that's an interesting model. Typically, what I'm used to is what we call developer terms on land acquisition. When we sign purchase and sale agreement and tell the seller, here's an earnest money, it's going to be sitting in escrow,
Mhm.
and we're going to close when we get the building permit. Well,
Yep.
it could easily take 2 years to get a building permit.
Yeah.
Sometimes they would negotiate a release of earnest money upon, I don't know, a land use permit or something like that.
Mhm.
Not a building permit, but when you get through your first round of
Yeah.
entitlements. But that's pretty common for larger transactions. What I personally like doing, and that's what we advise to a lot of our partners, property owners, is we say, look,
Mhm.
let's go to the bank. If you already own the land, let's go to the bank and leverage that land. Most banks would give you 50% loan to value. Some private lenders could go up to maybe 60, 65% loan to value. It's less common and it's a lot more expensive. But with a commercial bank, especially if the land's free and clear, they know that it's an easy path. It's an easy exit for them. And that would typically finance our development stage. But then I've also seen deals. I wanted to ask you about the LP and GP structure. The recent deal that we've been working on, we had a double promote system basically, where we had one LP structure within the LP bucket, where we would bring in limited partners, and those would be reserved for larger investors, either big family offices or institutional investors. But then on the GP side, we would also allow retail investors to come in and participate with us on the GP side.
Mm.
So even though it's called GP, general partners, uh, it really isn't. The investors that come into the GP bucket, they're still limited partners, but they get to participate on that second
Yeah.
side, if you will.
Yeah, I'd be careful with that because as long as they're actively participating on the GP, you can get with the SEC. There could be ramifications on it if you do get audited, or people if they're not doing anything. So all of our GP, and look on our general partner side, it's typically no more than 5 people at most, and they're all bringing something to the table that I could not bring. For example, if I'm doing a $30 million development, our net worth isn't $30 million. So collectively between all of ours, or maybe we have one net worth partner, he's or she's bringing in that checkbox, but they're also assisting, they're joining calls, or participating in maybe the monthly updates, doing walkthroughs, et cetera, of the development as it's happening. And then we may have some capital raising team members, but also each one of them, they're not getting paid based on their raise amount. It's based on their participation. So the idea, I mean, ideally, and what happens is as you start doing this, you start doing a rinse and repeat. And those that, partners that you tend to continue working well with, or who say or do what they say they're going to do, it works great. But our GP percentages are typically the same for CREI Partners. It's 25% GP, 75% LP. All of our GP, like when we invest, and we invest in all of our deals, we invest as limited partners. So even though we're stuck in the GP, we'll invest, and that it goes under the LP stack. So if I invest $100,000 in a $2 million deal, that, I only need to raise $1,800,000, right? So that 200,000 goes there. The GP, based on the percentage, and again, because we have a lot of hurdles, like for us, and I've had people say, man, like, Wayne, your hurdles are way too pro investors. That's okay. Like, my goal is to make those investors out there as wealthy and as quickly as possible, so that they tell their friends and they come back to us. So what we do is a 75-25 split, 75% LP investors, 25% GP. It ranges from 7 to 10% preferred, depending on, which investment class. And that goes up to 18%. Once we hit 18%, then it goes 50-50.
Right. Well, and I think it's also important to know that different companies, different ventures are structured differently. As long as you can do literally whatever you want, as long as it's all described, right? As long as your PPM explains all the little nuances,
Yeah,
so that nobody could come in later and say, you misled me. You told me that it was going to be X and you did Y.
absolutely. That's such a great point. And for us too, it's like our investors, majority of them, and it's fun because now they're starting to tell other people, and other people are joining in. So our marketing efforts aren't as active. I mean, we are still on social media. We're doing this podcast, but a lot of those investors are starting to come in through referrals. Once they've seen our PPM, it doesn't really change. The investment thesis of the new property changes, of course, but the terms. So it just makes it a lot easier when sponsors aren't changing all these terms every single time they do a deal. It makes it a little bit more complicated for an LP investor to get their head around some of these things.
Right. Well, and we're also competing with the giants of Wall Street, with these huge REITs, billion-dollar, trillion-dollar REITs that are perceived to be safer because they're big company. But the reality is they're not always are.
Yeah.
And they allocate a certain amount of money to a different project. If that project goes upside down, it doesn't mean that they're going to back it up with their $1 trillion fund. They might as well just cut it off and sink it if it's not worthwhile.
That's a great point. And one thing I want to mention, because you also made an awesome point regarding, like, sometimes it takes 2 years for building permits. So know your backyard. For us, City of Bryan and College Station, they're very pro development. They're very, like, they want to assist and see growth in the area. So if it's already zoned, it really would take maybe 4 to 5 months, if that, to get a building permit. I mean, really, they'll want to see the plans. So the plans may take 3 months. But for us, like, we use a local civil engineer. I think that's important. Have your civil engineer sort of local, knows, the ins and outs of city council and what the policies are on, the regulations. I think is important, and then from an architect, MEP, I mean, they're usually building to code. So whatever that code is, local. So, for us, that's another reason why, I develop in our backyard and not go to other cities, because you do have that risk. I would agree. If it took 2 years to get a building permit, we would not be doing this type of debt structure that I'm talking about. That would not make sense.
Well, and it's much riskier too, right? If you don't know how long it's going to take you to get a permit, then it's a lot riskier. I was just recently reading an article in the paper, local paper here, Puget Sound Business Journal, that one of the developers sued a city in the state because they had some development agreement with the municipality, with the local city, and they accused the city of tightening their requirements and not following the agreement, and they sued them and won a huge settlement. I was shocked. I'm like, so many times I got angry at municipalities, and I'm like, I'm going to sue them, but everybody's telling me, just don't bother.
Yeah.
Going against the city isn't going to work. So that was an interesting example. But yes, you're absolutely right. Working with municipalities that especially if you have relationships with the planning department, with the development department, mayor, whatever the structure is,
Sure.
It's going to be super important.
It's a lot easier when you have those relationships. And it doesn't start, you don't just get those relationships day one. I mean, just basics of networking, find somebody who's already in and build the relationships internally. Like if somebody already knows person A and they trust person A, like let's try to get in.
We're in the Seattle area, Western
Yeah,
Washington,
okay, so I'm
so
sure. I think, don't know.
plenty bureaucratic.
Yeah, I'll say in Texas, it's very like it's not one of those states where it's like, what can I do for you right off the bat? It's not like when I was in Washington D.C. I lived there for like 2 years or 5 years actually. And when I would go to a bar, I was in my early 20s. I would go somewhere. They wouldn't really want to get to know me as a person. They wanted to know who I worked for and like what could I do for them. The thing I love about Texas, at least not all parts of Texas are the same, but like it's you get to know them as a person. You build those relationships, and it's not from a standpoint of like you're wanting something from them. You just want this bond or get the relationship, and from there see what happens down the road. So every part of the United States is going to be different culture wise, but I would say here it's been great to get to know the mayor and other city council, et cetera, however each area is formed. But just genuine relationships, they go a long way. Right. And it's selfish, sacrificial, like that stuff just turns me off, and I'm just like it. I know that's part of some areas. I know Washington D.C. I mean, deals happen, I'm sure, a lot faster because they go right to the chase. But I want to get to know you before I buy, invest in an area, et cetera.
Right. Well, I think relationship, it's funny. This theme is kind of a recurring theme on the show. We talked about building relationships with vendors, subcontractors, investors, now politicians. But it's all, that's what we're all based around, right? It's especially real estate deals. They're emotional, and especially where people live, right? If it's residential, multifamily, you will have living people in your building. So you can't separate, it can't just be a transaction.
Yes.
Because ultimately there's going to be a human being there. So there's always that element. And when you're talking with investors, I find that, there's some schools where it's very transactional. You have like this scripted conversation and how you pitch the deals. And, a lot of people love these webinars or in-person seminars where they pitch deals. But I personally feel like unless I actually have a true, genuine conversation with the person, understand what they want, and they know who I am, I don't know how to make deals any other way.
Yeah. Well, even to the point where I was, city council meetings, and, these developers will have their attorney be the one talking at city council about trying to rezone. I'm like sitting in the city council because I recently went through a rezoning on a project, and I'm sitting there. This person's not even there. The main person who's trying to rezone is not there. He has his attorney, and it was a pretty easy no. Like it just was very. I'm like, guys, man, like no matter how successful you are in development, like show up, be that person to talk through your plans, because there's certain things you can outsource, but when it comes to that, I just feel you have to show up. We had to rezone some land, and it was retail. It was rezoned to multifamily. And, I went to the HOA meetings. I went to many of their couches to sit and hear. I mean, almost like being a developer is easy, in my opinion, if you have the zoning. I mean, it's sort of like being a quarterback. You just bring people smarter than you, the civil engineer, the architect, lender. I mean, you're sort of the quarterback, right? You surround yourself with people who are experts at whatever you're developing. But the part that's really a struggle that really made me realize I'm a developer and not many people like me in some cases is I had to go sit and talk to them and get to know them and understand, like, here are their concerns, and then how am I going to address it on my development? Because if our apartment looks in on someone's backyards, I mean, I understand that there's some concerns there, or if there's a safety aspect, if we're doing a pickleball court, and it's right next, to certain homes, like, do we move it? Do we put it inside? I mean, it's not only politics that you have to, try to get to know people on that side, but also the people that this is going to actually impact too.
I frequently describe real estate development as kind of like running a business.
Yes.
Hiring a bunch of people with certain skills is not enough. You need to develop their leadership qualities. You need to be interested in what they want to do. There's a lot of emotional component
Hmm.
to running a business and being a leader in a business, and real estate development is just like that. Yes, you
Right.
can hire a ton of professionals to do their work, but unless you're there and you're managing this various different
Hmm.
components and adding this human element,
Yep.
you're shooting yourself in the foot. You have to evolve that and kind of cover all bases.
That's right. You got to show up. I mean, no matter, especially, we're dealing with millions of dollars of developments or, lender money or equity money or our money. It's just certain things you can delegate and you should as a leader, right? But certain things you got to show up and you got to be the captain, of the ship. People want to see they have a leader, getting them through the hardest part. And development, once you surround yourself with people better than you, it does get easier, but doesn't mean you can just go off months at a time and go do your thing. Like you,
Right.
you need to be local. You need to, be on these weekly calls, participate. If not you, someone very close to you sees very eye to eye on your vision.
Absolutely. Wayne, this was very interesting, very educational and inspiring. Thank you for joining the show. Is there anything else you would like to add, point out, something about your current projects that you would like to mention?
Yeah. So I just encourage those that are out there to, consider, if they're passively investing in real estate, if they are more cash flow or equity investors or a little bit of both. I think that's a starting point. We have an investor education platform that's free. It's at passiveinvestorcoaching.com. And there's about 8 hours worth of content that I've put together to educate. It really accelerates people's um, education on passively investing in real estate. But other than that, for those that are actively looking real estate, I mean, I just, encourage those to show up, as we talked about, build the relationships, and obviously continue listening to your podcast and reach out if they need anything.
Excellent. Thanks again, Wayne. We'll have all of the contact information and show notes. It was fun.
I appreciate you. Thanks for having me on.